Hello, accounting superstars. This is Professor Don Bush. I've been a professor for about 30 years, CPA for about that long, and I've got great ways to explain accounting. So welcome aboard. Today we're studying about bonds. And I used to think bonds were the most boring thing in the world until I realized, my goodness, bonds are the basis of our monetary system and it's the basis of finance. If you want to be good at investing, you have to understand bonds. There's no two ways about it. Now, we can also apply this knowledge to real estate. A lot of things cross over. So, a lot of good stuff. Hey, well, I'm here in Colorado, in Conifer, Colorado, which is up in the foothills, a beautiful place. And today is a nice, warm day. So, pretty soon after I film this, I'm going to take the dog for a nice big walk. So, he's looking forward to it. So, let's get going here. So, here's what's happening. We've got Fred's snowblower service. And Fred has been spectacularly successful. In fact, he wants to borrow $1 million and he wants to expand his business to Phoenix, Arizona, Las Vegas, Nevada, and the Florida Keys. So he's excited because there are no snowblower shops in any of those places. So he'll be the only one there, no competition. So Fred is going to go through an investment banker who is going to match him up with some people with some money. And so here's what we have going on. Here's a picture of a bond right here. And it says, I, Fred, promise to pay $1 million in 10 years. In addition, I will pay 6% interest paid every 6 months. Now, here's a key thing. You got to get this. Are you ready? The 6% interest is on annual terms, all right? When we talk about interest rates in accounting, finance, business, it's usually always on annual terms. So that means 6% per year. Now, the interest is going to be paid not every year, but every 6 months. So what we're going to do, we're going to take that 6% and divide it into 2, cut it in half. Cut it in half, divide it by 2 to get 3%. So 6% a year is the equivalent to getting 3% every 6 months. So you've got to understand that. All right. So going on here, here's another thing, is that the market rates have a big influence on what Fred's bonds will sell for. You see, Fred's bonds will probably go up to maybe for auction. And so people will be bidding on the bonds. So what the current market rates are is really important. Now, Fred is promising to pay 6% interest. But here's a question. Number one, if current returns, the market rates on similar bonds are 10%, is Fred's bonds more or less desirable? Well, think about it. If somebody else's bonds, in fact, probably a whole lot of people's bonds are paying 10% and Fred's bonds are paying 6%, which bonds would investors go for? Now, I've got a high-tech teaching instrument here. It's a pencil. Okay, here it is, my pencil. Now, just pretend that the eraser here is Fred's, the dollar value of Fred's bonds, all right? So when interest rates are up, like they are here in question number 1 here, bonds of similar bonds are going up to 10% or paying 10%. That the eraser goes down, right? Okay, interest rates go up, eraser goes down. So what this eraser reflects this is Fred's, the dollar value of Fred's bonds, okay? So watch the eraser here. Interest rates go up, the dollar value of Fred's bonds goes down. All right, now question number 2. If current returns or market rates on similar bonds are just 2%, is Fred's bond more or less desirable? Well, Fred here has promised to pay 6% per year, and that's in the contract. Can't change that. But current returns, the market returns, are only 2%. So what bonds will investors gravitate towards? So use the pencil again. So if market rates are dropping, what's happening to the eraser? The eraser is going up, all right? That eraser is the dollar value of Fred's bonds. So when interest rates are dropping, the dollar value of Fred's bonds go up. And it always works this way, always, 100% of the time. That's nice. Number 3, Fred's bonds pay 6%. What is the interest rate every 6 months? We talked about that. that 6% is on annual terms, but the payment is going to be every 6 months. So we have to take that 6%, slice it in two, okay? 3%. 3% every 6 months. Now, here are the bond details, folks, right here. And a lot of this is a repeat. So the principal here, the face value of the bonds is $1 million. Now, where do we get that? Well, it says right here, I, Fred, promised to pay $1 million in 10 years. So no matter what happens to interest rates, Fred has got to pay $1 million in 10 years, all right? And he's also promised to pay 6% interest. So here we go. The interest rate on Fred's bonds is 6%. It's also known as the contract rate because according to the contract, it's 6%. Another term is nominal rate. Another term is stated rate. They all mean the same thing. The current market rate is 5%. So check this out, guys. Pencil time. The eraser is the dollar value of Fred's bonds. The market rate is lower, going down. The market rate is lower. So what's happening to the value of Fred's bonds? Going up, which brings us to the next part here. The selling price of the bond is $1,077,946. So it's a good day for Fred. He's borrowing $1,077,946, but he only has to pay $1 million back. Fabulous. All right. And there's a lot of reasons for this too. I won't go into those reasons, but this is just how it works. The bond term is 10 years. And the number of 6-month periods is 20 because there are 2 6-month periods per year. So 10 times 2 is 20. The amount of the payment each 6-month period is $30,000. So where do we get that? Well, if we take the 6% interest per year, cut it in half into 3% every 6 months, 3% times $1 million is $30,000. So the date bonds are sold is July 1st, 2001. The date of the first interest payment is 6 months later at the end of the year, December 31st, 2001. Our first step is to create an amortization table. Now, amortization tables are super easy. They are incredibly easy. And once we get our amortization table done, we've got all the answers. So actually doing bonds is really easy stuff. So here's what's going on, guys. What we do is in time period 0, we're going to take the amount that the bond sold for, $1,077,946, and drop it right here into the first line, $1,077,946. That's how it all starts. So you don't put the $1 million there, the amount that's owed, but what it's sold for. Now, each 6-month payment is $30,000, and it's right here. How did we get that? One more time. 6% interest per year divided by 2 is 3%. 3% of $1 million. It's not 3% of $1,077,000. You know, it's what is owed. It's according to the contract. Now, the interest expense is 2.5% times $1,077,946. And you might be saying, oh, wait a minute. Where are you getting that 2.5%? That's weird. Haven't seen that. Well, what it is, the market rate is 5%. And what we do, since the payments are every 6 months, is we cut it in half. 5% divided by 2 is 2.5%. So that's where it comes from. So we're using the market rate. So 2.5% times 1,077,000 is 26,949. Now the premium reduction, this is also easy. You just take the 30,000 minus the 26,949 and you get 3,051. And finally, to get the bond carrying price, all you do is take 1,077,946 minus $3,051, and there you go. So it's just that easy. So let's do another line or two so you will have this. So line number 2, 6-month payment is $30,000. The interest expense is 2.5%. 2.5% of what? Well, 1,074,895. So there we go. So how do we get the premium reduction? All we do is subtract 30,000 minus 26,872, and we get 3,128. How do we get the bond carrying price at the end of the second period? we just take 1,074,895 minus away 3,128. And here we go. 1,071,767. There you are. So let's do line number 3 here, period number 3. And I think you'll have it. So the 6-month payment, 30,000. The interest expense is 2.5% times the carrying value, which is 1,071,767. So there we go. And the premium reduction is 3206. There we go. The bond carrying price. There it is, 1,068,561. We got that by taking the previous bond carrying value minus the premium reduction. And there it is. So I hope you got that. It's really easy. And all amortization tables work the same. So I'm going to just fill in the numbers here. Now, one thing that's pretty cool about these amortization tables, this final number is the contract amount or the principal. Remember up here it said, I, Fred, promised to pay $1 million in 10 years. So the end of the amortization table should be $1 million. Now, you might be a couple dollars off because of rounding errors, and that's okay. But if you're $100 off or $500 off or $1 billion off, you did something wrong. So should end up being very, very close to that principal amount, the contract amount. So let's do journal entries. Now, journal entries are super easy. We've already got all the hard work done. So let me get the web page here lined up. So this is the journal entry for period 0, the sale of the bonds. So how much money did Fred get? Well, Fred got a grand total of $1,077,946. That was more than he was expecting. So cash, $1,077,946. Now, how much does Fred owe? He owes $1 million. There we go. Bonds payable, $1 million. The premium on bonds payable is the difference. There we go. Easy, easy, easy. So I'm going to change the color here back to what it was originally. There we go. Well, let's do the journal entry at the end of the first 6-month period. So it's really easy. All we do is we're going to use these 3 numbers right here, right off our chart. So it doesn't require any thinking whatsoever. We don't have to do any calculating. It's right off the chart. It's easy. So I'm going to scoot this chart down just a little bit. There we are. All right. So the interest expense, all you got to do is look on the interest on the chart and look for the interest expense, $26,949. There you go. Premium on bonds payable. Now this represents the reduction of premium, $3,051. And how much cash did Fred have to pay out? Well, according to the contract, $30,000, and it's right here on the chart too. So there you go. So the amount of interest for the very first year, since it was just a half a year, $26,949. So let's do the journal entry for period 2. It's really easy, guys. It's the same idea. No different. So we just grab the 3 numbers for period 2. There we are. So the interest expense, take it right off the chart, $26,872. The reduction in bond premium, $3,128. And how much cash did Fred have to pay out? Well, always $30,000. That's the contract. Well, let's do the journal entry for period number 3. Again, easy. It doesn't require any thinking, no calculating, where all the hard work is done. And it wasn't that hard of work to begin with. So here we go. Interest expense, take it right off the chart, $26,794. Premium on bonds payable, $3206, and cash is $30,000. There you go. So, folks, that is how you do this. So, last question here. What's the grand total for the second year? So, in the second year, there were 2 interest payments, and we have one of them right here too. So, I'm going to just change the colors just so this makes a little bit more sense. There we go. So, the interest for year 2 would be the $26,872 and the $26,794. So all you do is put those right down here in the chart. There you go. $53,667 is the grand total for interest. So, ladies and gentlemen, that's our very first introduction to bonds payable. I hope it was easy. It should be easy. So if I went too fast, just rewind and watch the video again, but I'll make a few more about bonds too. So check out the website, accountingsuperstars.com. I've got all my videos listed out by topic, so they're easy to find. And hit that subscribe button and the like button. That way YouTube will know that you like these videos. I'll know that you like these videos too. And until next time, over and out.